This is a production of Cornell University.
I'm Louis de Longzan, an undergraduate in the College of Arts and Sciences and president of the Cornell International Affairs Review. I'd like to welcome you to our second panel discussion of the semester on the financial crisis and its implications for Washington, Wall Street, and Main Street. It's very courageous of you to cross the campus on such a rainy day, and I'd like to thank you very much for your presence, and it's quite an honor to have such a full room tonight. I'd like to recognize first the work of our executive board, present today, to put together this panel on such a short notice. We started Friday, and it was an intense few days, and this is quite a successful event, and it will be quite a successful event. I would like to recognize their flexibility and their dynamism and their adaptability. In the name of the board, I would like to thank our panelists tonight for taking, again, on such a short notice, for responding to a student initiative, and for taking their time to inform us on this quite important issue. This panel illustrates Cornell at its best, with mobilizing Cornell resources across colleges and bringing them together to discuss this crucial topic from different perspectives, from the economics perspective, from the industry, the finance industry perspective, and the political science perspective. This as well illustrates the objectives of the Cornell International Affairs Review of having an international, interdisciplinary, and intergenerational approach to world affairs. Indeed, we believe that bringing together the views of students, young and full of idealism, with the vision of policymakers and the perspective of scholars offers interesting tools to analyze the world in its complexity and nuances. This panel will be introduced by Francis Pedraza, new member on our executive board, who will give a fresh student perspective on this talk and introduce our panelists. Each panelist will then go for 10 to 15 minutes first round, followed by a second very brief round of responses, and then Sarah Eversman, officer on our board as well, will moderate the question and answers, and the event should be over before 6:30. Again, thank you for your presence.
Ladies and gentlemen, thank you all for being here. I really appreciate it. This panel, as you know, convenes in a moment of national crisis. I won't belabor the dire circumstances. Credit markets in a state of turmoil, stock market plummeting, financial behemoths collapsing every week, almost every day, calls for government intervention on a grand scale, and the drama of Capitol Hill and presidential politics only a month away from an election. Last Monday, I wrote in a column that too many Cornellians seemed oblivious to the gravity of these events. At least with this gathering today, I've thankfully been proven wrong. It shows that students have started to follow the markets very closely as they affect our families, our careers, and the political and economic future of this nation. Over the last several days, I've mulled over the various aspects of this crisis in my own mind, and I'll share just a few of them because I think they'll frame the speaker's talks quite well. I'm sure that, like many of you, I grew up with an inherent trust in what I saw as the American system. I looked around and I saw a vibrant economy whirling about me. It created technology, raised skyscrapers, and allowed for a pleasant lifestyle. I took away from this a deep trust in economic freedom and minimal government. The formula was that the profit motive would encourage productive work, which would provide abundant opportunities and lead to the creation of self-regulating free markets, which exchange goods and services, creating wealth. In the end, everybody would be better off, the formula goes. This crisis has shaken that confidence, that trust, that faith in free markets and government to its roots. It has made me fear for our ability as a political community to cope with emergencies nimbly and with decisiveness and pragmatism. It has prompted me to ask tough questions. If Americans observing the financial crisis do not understand its causes or fail to grasp the nature of its immediacy and long-term economic consequences, they cannot take the right lessons with them to the polls, and the fundamental problems of the economy will not be solved. And for these questions, we turn to our two experts in finance and economics. Professor Robert Andolina, a visiting senior lecturer of finance at the Johnson School, had an illustrious 19-year career in the equities business, which culminated as a managing director at Lehman Brothers. Professor David Easley brings all the analytical insight of a trained economist with almost 30 years of published work. But economics dances with politics, and so we turn to our expert in the government department to help explain the political dimensions of this crisis. What role for government will emerge? Will it be a temporary intervention, or will a vast, permanent expansion of its powers take place? Can the urgent, huge systemic problems in the financial system be solved without creating an arbitrary, capricious, and dangerous discretionary powers for government? Professor Elizabeth Sanders will help unveil the profound political implications of these last 2 weeks. She's a renowned scholar and teaches undergraduate and graduate courses on state expansion, the American presidency, and foreign policy here at Cornell. Let's welcome these three panelists. We're honored to have them join us and look forward to hearing their insights. First up, we have Professor Andolina.
Well, that was a very enthusiastic and eloquent introduction and framing of this session. I have to say that I'm as excited as the rest of you here because it gives me a chance to learn from my panelist partners on different elements of what's happening with this crisis that I don't usually get a window into. So I'm as excited as you are, although I might not be as eloquent as you, Francis. My role is to basically frame a couple of things in terms of the market environment and the vehicles, investment vehicles, at the core of the discussion. So what I'd like to do is three things with my 10 to 15 minutes. I'd like to talk about the market environment post-technology burst, post-technology bubble burst, and how that might have set up the environment for the vehicles that we're now kind of debating and scrutinizing. I want to spend a little bit of time on the investment vehicle itself, and I want to touch briefly on a couple of market responses that in some senses might not have flowed logically from the news and the events that we read about in the newspaper. So let's start with just a quick recap of what happened post the technology bubble. And the technology bubble really kind of burst in the first quarter of 2000. And by the time that we got to the end of 2000 and we were entering 2001, there was a fair amount of angst over the global economy. It wasn't just in our own shores. It was central banks across the world that were concerned about their regional economies and the effect that the value destruction that we saw in the equity markets in the US and around the world would have on those regional economies. Also leading up to the end of 2000, we had gone through a series of interest rate hikes. The Fed funds target rate, which is you can think of it as the key metric by which people gauge liquidity. Is money available? Is it harder to come by? Is it easier to come by? The Fed funds target rate is the metric that most people cite, most press sources will key on to figure out what the attitude toward lending and money availability is. We had gone through a series of tightenings and we ended 2000 with the Fed funds rate at 6.5%, the target rate at 6.5%. The course of the next 4 years, really from January of 2001 to June of 2004, we went through one of the longest monetary policy expansion periods in the post-war era. Okay, there were 13 consecutive reductions in the Fed funds target rate. We went from 6.5% target to 1% in June of 2004. And so you look at that and you think that that's dramatic enough. On top of that, we also had a fiscal policy complement in the sense that the deficit as a percentage of GDP was also increasing. So we had easy money. We also had spending on a relative scale that was more substantial than it had been in the past. Now, when we think about that move from 6.5% to 1%, we think also that maybe 3.5 years is not that short a time frame. That should be a reasonably orderly market progression. But in fact, the bulk of that easing, 11 of those 13 interest rate reductions, came in 2001. Okay, so we started 2001 with Fed funds rates at 6.5%. We ended that year with Fed fund rates target rates at 1.75%. Okay? And so if you're an asset manager, step back now, put yourself in the place of somebody with a fiduciary responsibility for assets. You're an asset manager, whether it's a hedge fund manager, an insurance manager, a pension fund manager, foundation manager, mutual fund complex manager, and your job and your responsibility to the people that have put money into your funds is to seek returns. And you're not getting it from the equity markets. You've seen that as the meltdown continued. You're not getting it from the bond markets. Yields were very low, and they got there quick. So if you were a buy and hold type of investor, you had very little time to play the decline in interest rates and the spread compression. Okay? There was also kind of, I think, a psychological factor playing as well. There was a lot of angst in the public eye about risk-taking for the purpose of generating return. And so here, in addition to your responsibilities of trying to find a reasonable return, you had to do it in a relatively safe way. Okay. I think we got to a point now where managers were looking for high-grade commercial, corporate bonds, highly rated, AAA rated corporate bonds, probably in excess to the supply that was available. So the opportunity for financial innovation is now open. Okay? Who can come up with something that will generate a reasonably high return or a higher than current return with reasonable investment risk? Okay. Now, that's kind of what opened the door for the CDO, and asset-backed securities in general. The CDO specifically is what we seem to be focused on today. The CDO at the time was not a brand new structure. It was a structure that was introduced in 1987, so it had been around for a while, but it had been used primarily for corporate purposes to mitigate balance sheet risk. It was now being used for arbitrage purposes as a structure. And the way this worked, if you think, I'm going to just simplistically kind of go through a CDO. A CDO is, in essence, a payout structure based, as the name might indicate, collateralized debt obligation, based on the cash flow generating capabilities of the assets that are backing that obligation. And the collateralized assets, or the assets that are backing these obligations that we most normally hear about, are mortgages today. So we can stick with that as an example. The way these work is that mortgages are sourced from the mortgage originators, the people that go out and talk, all these credit-worthy individuals into the fact that they need a bigger house and can borrow money and don't have to put anything down and all those good things. And so they originate these mortgages, and the banks source these mortgages and aggregate them into a pool. What they have at this point is basically a pool of assets that have an ability to generate cash flow. Okay, but then they take that pool and they securitize it. Okay, they create a security out of the cash-paying abilities of that pool of assets, and they tranche it. Okay, they divide it into pieces, and each of these pieces have a certain set of obligations or promises that go with it. Okay, the most senior tranches have the best deal, okay, least risk, and they generally carry the lowest interest rate, but they have a high quality feel to them because the obligations that are made in the repayment of the economics that you're signing up for are better than the lower rated tranches. Okay, so for a CDO structure, again, you're taking all these mortgages, you're putting them together, you're putting them into a payoff structure, and then you're carving them into pieces and you're sending them up to the rating agency and saying, okay, here are the payment characteristics for this particular tranche of the CDO, what do you rate it? And the rating agencies would look at it, and they'd look at the historical default rates, and they'd look at historical delinquency rates, and they'd look at the geographic dispersion, they'd look at whatever they looked at, and they said, okay, I think that this, 80% of this structure, this big tranche here, that's a AAA rated paper. And that's a very high quality piece of paper. These other ones, these lower ones, those, we're a little bit more concerned about that, so we're going to rate those lower. And the very bottom one we're not going to rate. We're going to call that equity. Okay? So now you've got a payoff structure that's born of assets, mortgages, other assets, but more, let's say mortgages. And you can see that there is now in this structure leverage. Okay? You've got a debt structure in the senior tranches, and you've got an equity tranche as well, which creates a leveraged structure. Now, it's important that the banks that were creating these products and distributing these products, it was important that they did not keep these loans on their own books for a number of reasons, predominantly regulatory capital reasons and funding reasons. By separating them from their own balance sheet, they could send them, they could fund it more cheaply, and they could fund it more cheaply, and it didn't impede their regulatory capital. They have a commitment to lock up capital or freeze capital as relates to certain assets they keep on their books. So it was important for them to isolate these activities, these loans off of their books, and that's the creation of an SPV, or a special purpose vehicle. These vehicles could often go to the funding markets and secure funding at cheaper rates than the investment banks or the banks could, because they were an entity that was based on certain cash flow characteristics defined by the assets that they held. They didn't have the rest of the bank structure to impede their credit rating and their ability to borrow. Okay? It's these same SPVs or similar vehicles that the banks found that they could put CDO product in, and as the market continued to do well, the real estate market continued to do well, prices continued to go higher, and people paid their mortgages. Some of those pieces of paper performed pretty well, and they generated a performance on them. They found that they could take that performance and go out and raise external capital and create, in essence, an investment management vehicle out of this SPV. All right? These SPVs operated with leverage. Generally 10 to 15 times leverage. So they would go, again, to the commercial paper markets and pledge their asset-backed securities as collateral for funding. All right? And so this is kind of the issue or the situation that's been created. The market continued to rise. The real estate environment continued to be relatively healthy through 2005, certainly. And there was an explosion in the origination of CDO product. And the leverage effect in the environment created the issues that we have today. When this SPVs went to the commercial paper market, and this is a short-term market, okay, so this is one of the effects that we've had from the issues now in the deterioration in the mortgage market. When the SPVs would go to fund their investments, they used the commercial paper market, which is a short-term market. Anything less than 270 days is generally the term of the commercial paper market. So that means that they're refunding or refinancing, in their case, usually about every 90 days or so. Now, if you think about your own situation, let's give you a leverage situation. Let's say you buy a $200,000 house, and you put 10% down. Okay, so you got $20,000 in the game. You're carrying a note of $180,000. And now let's say that the real estate market goes down, and you know it's gone down because all the houses around you have turned over, and they are going for 10% less than what they were when you bought. Theoretically, you have a house worth $180,000, which means your equity is worth zero. Okay? A 10% move in your house price causes you to lose all of your equity, which is, what's the big deal with that as long as you don't have to sell it or refinance it? If you don't have to sell it or refinance it, you don't really have a problem so long as you can continue to pay the mortgage. The issue with the SPVs is that they had to refinance every 90 days or so. They had to refinance on a short-term basis, and their assets were illiquid, longer-term oriented assets. And when you have to pledge more of those assets as collateral to get your funding, and the cost of your funding is more expensive, and it starts to exceed the cash flow that's generated off of those assets, you can see that you come to a crossing point. Okay? When you get that crossing point, that's where these SPVs get into trouble. They can't refund the debt structure, therefore they've got to sell assets, and they're not selling assets into an environment that's accommodative. Okay? It's more difficult to move these illiquid assets in a market that doesn't want them. All right? That's what sent the first shock into the commercial paper market. The second shock came on the default of Lehman Brothers. These SPVs operate off balance sheet, so generally they were isolated from the host bank or the bank that initiated them. But a lot of these banks took the SPVs back onto their balance sheet because they felt a reputational obligation. When Lehman Brothers went down, the debt obligations of Lehman Brothers defaulted. And one of the largest participants in the commercial paper market are money market mutual funds. And all of a sudden, you're sitting there as a money market mutual fund manager with $750 million of Lehman commercial paper that's, keeping the value of a share of your mutual fund close to 1, right? And all of a sudden, it's not worth what it's supposed to be worth on the books. And you take a markdown, and that's when your share in the mutual fund goes from $1 to 98 cents, and you start wondering who else is next. The asset-backed commercial paper market is half of the whole commercial paper market, okay? So it's about $1 trillion plus out of a $2 trillion market. So when people start worrying about this stuff, that's when you start getting flight to quality. That's when you start getting flight to, mattress equivalents, right? You take your money out of the bank because you don't know whether the bank is safe, whether the bank's got exposure. You take your money out of the money markets because forever and ever and ever, it was worth $1, a share, but now it's worth 98 cents. Nobody is supposed to have a money market fund that's worth less than $1, right? And this is where we get to the confidence issue in the crisis, and that probably makes sense for me to stop right there.
Well, I'm going to build from Bob's remarks, but first I'll make a few general remarks and then come back to the specifics. So the first thing is there actually is a crisis. I mean, that should be obvious by now. But what doesn't seem to be obvious to a lot of people is that it's not just a financial crisis. It's not just a Wall Street problem. It's also a Main Street problem. I mean, it's beginning to have real effects on the economy. And unless it's addressed pretty soon, it's going to have serious, long-lasting effects on the economy. That's something a lot of people haven't gotten yet, and I think it has something to do with how this has been explained. So I want to come back and try to explain why that's going to be the case. But I want to make one other remark to start with as well. When people are talking about the bailout package, they're talking about $700 billion, and that's obviously a lot of money. But what's often missed in that discussion is that the taxpayers are already on the hook for a massive amount of money that we just seem to conveniently be forgetting about. The FDIC insures deposits in banks. If banks fail, somebody has to cover those failures, and it's going to be the FDIC. The FDIC is us, right? We're on the hook for all of those bank deposits. We now insure money market fund deposits because of previous runs on money market funds. We're on the hook for all of those deposits too. Nobody knows how big that bill is going to be, but it's not zero. There are other aspects of this that also are getting ignored, like tax revenues. You can be sure that tax revenues in New York State and New York City are going to fall. That revenue's got to be made up in some way. You raise tax rates, you cut expenditures, perhaps you borrow, although at this point, borrowing in the municipal market is really challenging. That market is almost shut down. There have been a lot of bond efforts lately that have failed. The ones that have succeeded are paying exorbitant interest rates, at least relative to what the interest rates were just a few months ago. We're on the hook for this too, right? There's going to be big costs there. Now, the other thing that people talk about here that we're on the hook for that actually does get some attention is that the stock market decline actually affects all of us. So that is a financial aspect, but it affects everybody's pension plans. It affects the value of everybody's savings who's in the market. The market fell by over $1 trillion earlier this week, right? Far more than the cost of the bailout package. Now, it went back up by a lot of that the next day, and today it didn't do much of anything. So we've recovered some of it, but not all of it. We're, of course, already on the hook for a lot of bailouts that have already happened, too. So just let me read you a few numbers to put things in perspective. There's $200 billion promised to shore up Fannie and Freddie. Fannie, the institutions that the government is now essentially running directly. There's an $85 billion loan to AIG, which we will recover some of. How much of is still unclear. We made a $29 billion loan guarantee to JP Morgan Chase for their takeover of Bear Stearns. We've made all kinds of guarantees to Citibank in their takeover of Wachovia when Wachovia was going to go under. I don't know how much those are going to cost because they're guarantees that are contingent on lots of things, but they're going to be substantial. So there's a lot of stuff that's already happened. The one thing that hasn't happened is that the administration hasn't actually explained the idea behind the bailout. I don't think they've done a very good job of telling people why we need to do something, and I think we need to do something. It's not clear we need to do exactly what they proposed. It's not clear that this is the best thing that could have been created. It's actually not even clear that it's going to work. In fact, it's actually really clear that even if we do this, as it looks like now we may, it won't be the end of the story. I think part of the difficulty the public has with this is it's being sold by Treasury Secretary Paulson, who used to be the CEO of Goldman Sachs. And it's natural to be suspicious of a bailout that is going to benefit Goldman Sachs when it's being explained that way. So I want to try to explain why we actually do need to do it. But first, let me just make a few comments about Bob's remarks. I want to build directly from what he said. There's one other thing I want to emphasize, though, that in these loans that were made that actually began these problems, both sides were at fault. Both the people who took out the loans and can't pay them back and the firms that made the loans. So to give you the most egregious example I know of, there's something called a payment option arm. You don't need to know all the details of this, but knowing just a little bit will help understand how out of control things got. Payment option arm is an adjustable rate mortgage. Those are pretty standard. They usually went off initially at very low rates of interest. It's the payment option part, though, that's really odd. In a payment option arm, the person taking out the mortgage has the option to not pay if they don't want to. There's a minimum payment, but you don't have to pay principal. In fact, you don't even have to pay the interest. Everything you don't pay just gets added back into the mortgage. Now, this can't go on forever. There are lots of clauses that will cause this thing to be triggered so that you have to pay more and more. But as you can imagine, if you take out this kind of loan and housing prices don't go up, you're in trouble. In fact, they need to go up pretty fast in order to survive with this kind of loan. And that obviously isn't what happened. So these loans were really odd creatures. It's not clear to me why anyone ever thought this made good sense. I blame the people who made the loans for these, also the people who took them out. I mean, there probably should be some sort of rule that says that you can't make a loan that is that complex to an individual who isn't sophisticated enough to understand what they've just done. We have rules like that in the stock market. We don't have rules like that in the mortgage market. My guess is that we soon will. But we created these creatures, then we created complex derivatives and bundles of assets that the firms traded through a very interconnected network, so that firms were holding essentially contracts and insurance on each other's contracts for risks that in the end were highly correlated. So if you think about the way insurance might work, and to some extent this really was insurance that firms were creating. Some were speculating, some were insuring. If you're insuring against events that are independent, that's great. If you have lots of insurance contracts like that, you have a pretty good idea what the payout's going to be, right? Insurance companies don't worry about the possibility that there will be a massive explosion of automobile accidents across the entire U.S. in some year. Right? That's just really unlikely. With housing, though, that's not the same story, right? There's tremendous correlation. When housing prices go down, they do go down by different amounts in different areas. Some areas even go up. But housing prices tend to move together across the country, so there's a tremendous amount of correlation. Hard to insure against the risk that creates. Who's going to hold the other side of it? So that created contracts that were very complex, highly correlated, highly leveraged, and in the end, very, very hard to value. Figuring out how to value these things is, in the end, nearly impossible. There are lots of models. Those models didn't work because the contracts are so complex. What eventually happened is that the market for these things dried up, right? I mean, there's very little trade of the underlying securities now because no one knows actually what these things are worth. So there's a housing price decline, lots of uncertainty about how to value the assets that were eventually being traded. And as that goes on, firms are forced to mark down the value of their assets, as we've just heard. That creates a risk that's now feeding through the entire system. It's a risk of default or a counterparty risk in trading, right? Everybody becomes afraid that the people they're trading with will default. So you don't want to make someone a loan if you're afraid that they're going to not be able to pay the loan off. Or if you do make the loan, you want a very high interest rate. Or if you're going to make them a loan of some kind, you want a lot of collateral put up front. Or maybe you just walk away from the business altogether and say, I don't want to deal with this person. So imagine a complex system, lots of trading partners, and for some reason, pick some firm like Bear Stearns. Suppose that people who are trading with Bear Stearns become concerned that Bear Stearns is going to go broke, because we all know that they have a lot of this toxic debt on their balance sheet. We don't know what it's worth. They don't know what it's worth. And actually, it's not transparent. We don't even know how much they have, but we know they have it. If you become concerned they're going to default, you don't want to trade with them. Right? You certainly don't want to loan them money, and you probably don't want to do business with them at all. But of course, if enough firms do that, Bear Stearns is going to go broke. Right? Expectations of failure actually can create failures themselves. So if one firm goes broke, then this feeds through the network because when they default, other people who thought they were getting paid don't get paid. It creates a cascade of erosion of trust and lack of confidence that can cause the whole system to essentially shut down, at least temporarily. Now, up to that point, it sounds like it's just a Wall Street problem. I mean, it obviously has a big effect on lots of people, but it sounds very much like a Wall Street problem. In fact, though, it's not. It actually goes way beyond Wall Street. So let me explain a little bit more about how these cascades can work. Think about runs on banks or runs on money market funds. It's essentially the same story, and in fact, the runs that we've seen were created by exactly the same features. If you have money in a money market fund before we insured it, and you thought that other people were going to take their money out of the money market fund because they were afraid the money market fund would not be able to give you back $1 for every dollar, what should you do? Well, obviously what you should do is get your money out before they get theirs out, right? Because the money market fund is not going to be able to pay everybody off immediately, right? They're taking very short-term deposits, but they're making loans that are somewhat longer-term in some cases, and banks in particular make much longer-term loans. They can't pay everybody right now. If everyone starts trying to draw their money out, though, the money market fund is going to fail. The bank is going to fail exactly the same way. Runs like this are a problem that economists have studied for a very, very long time, and they are the reason that we have the FDIC to prevent this from happening to banks. They're the reason that we now insure money market funds, at least temporarily, because there were beginning to be runs on these funds. And if we allowed them to collapse, the commercial paper market, which is almost dead, would have completely disappeared. And I'll come in a few minutes to why that's actually really important for everybody. So we now have a system where people are afraid. Confidence has gone down. You're not sure who you can trust to trade with. Just to give you a couple of numbers or indications of numbers that try to put this in perspective. Last week, the yield on short-term treasuries briefly was negative. Okay? That is terrifying, right? You're paying the government to loan money to them? The only way that can make any sense is that you're afraid that there's nothing else you can do with it. Even putting it under the mattress is worse than doing this. Otherwise, why would you do it? The yield on short-term treasuries is now positive, but it's really, really low. What's going on is that financial institutions don't want to do anything with their assets except put it in the safest thing they can find because they're not sure what else is safe. The excess reserves in the banking system, which are typically on the order of a few $billions a day, have exploded. At one point, they were close to $200 billion. The Treasury is putting money into the system, trying to get banks to make loans. Banks are essentially saying, no, I don't want to loan to anybody at any interest rate because I'm just not sure I'm going to get paid. So they're just holding excess reserves. Okay. That is a finance problem, but it actually has huge implications for Main Street as well. So let me talk a little bit about why this matters for Main Street and why Main Street should really care about this. Let me start with the housing market. Okay. One implication of what's happened if firms don't want to loan money is that mortgages are going to be hard to get. You're going to have a much harder time qualifying for a mortgage, and interest rates on mortgages will be higher than they used to be. Finding it more difficult to qualify for a mortgage is probably a good idea, but it's going to become a lot more difficult, and interest rates are probably going to go up a lot. What that's going to do then is decrease the demand for housing. Right? If it's harder to get a mortgage, fewer people are going to be able to buy a house. If interest rates are higher, they're not going to be able to pay as much for a house. That will cause the price of houses to go down. It's already going down. It's going to go down even more under this system. As the price of houses goes down even more, there are more and more defaults, creating even less confidence that people are going to pay you back. And as you can see, this thing can feed back on itself, and you just get a cascade that goes down to the lowest possible point if nothing's done. This also matters for firms. Right? For a small firm trying to go into a bank and borrow money to undertake a new project, for a farmer trying to go in and borrow money to buy a new piece of equipment, they're going to find it really hard to do. Small town banks are probably still lending to people. Big banks are not so sure. Again, everybody is really uncertain about what's going to happen, and so they're drawing back. You hold cash, you hold treasuries, because you don't know if you're going to get paid back. And also, you're not sure that you might not need the cash yourself. Right? If you're a bank, if there's a run on your bank, you certainly don't want it to be failed. You want to have lots of cash on hand. So you don't want to make loans. But if you don't make loans, then businesses can't grow and expand. They can't hire people. In fact, they can't even pay them. They can't do it with bank loans. They can't do it with commercial paper because that market is also moribund. So we're at a point now where the real effects are beginning to be felt, and they're just going to get worse and worse unless we do something. It's also showing up in the market for state and local government debt. As I mentioned a few minutes ago, that market has almost closed. Lots of states and local governments are finding that their attempts to raise money fail. Nobody wants to loan them money at any rate that the government's willing to pay. So there are projects at the moment that are being put on hold. And this is just starting. It's likely to get worse unless an action's taken. Now that raises the question, though, of what the action ought to be. And if you follow my story, the action needs to be something that to some extent addresses the real problem. There is a real problem, but there's also an erosion of confidence and trust. So you need an action that's dramatic enough to change that. That's what the bailout plan is an attempt to do. And I don't want to talk about the details of the bailout plan because I'm going to run out of time for sure. I do want to mention just one last thing about this. Some people who are opposed to the idea of any kind of government bailout plan implicitly are making the argument that free and unfettered markets are the solution to everything. I'm an economist. I think free markets are great. But it actually takes some preconditions to make free markets work well. And some of the arguments against the government being involved are ignoring those preconditions. Right? I mean, the very first thing, obviously, is you have to have property rights and you have to have them enforced. Otherwise, what is it you're trading? But it's not just that. Right? There are lots of things that governments have to do. One thing that governments do that economists talk about all the time is they take account of what we call externalities. When you take an action that affects only you and the person who's freely entered into, let's say, a trade with you, that's fine. If you take an action that affects many, many other people, then those other people should be concerned about it too. Think about my bank runs example. That's exactly an example of that. When bank runs start, the actions that people are taking are having effects across the whole system. Those are circumstances in which it actually does make sense for the government to take a position and move in, because everybody acting in their own self-interest is not going to lead to a good outcome under those circumstances. It has nothing to do with free markets. It's just that in those kinds of circumstances, free markets need help. I think we're in a position where we need help. The only question is exactly what the help should be. But I should stop, and we can move on, and we'll all come back and make more comments.
My colleagues have done a wonderful job of educating me and all of us on the economic processes that led us to this momentous event, and I will focus my remarks on the political side. One, I think, can argue plausibly that this is a problem created by politics. At the very least, Bob mentioned actions of the Federal Reserve Board, clearly a governmental entity that created incentives for investment that then ultimately went awry. I think it is a political problem. I think it can only be solved through government. There seems to be a wide agreement, we'll see tonight at some point, whether in the Senate, at least a majority of that institution, will pass this really momentous piece of legislation. But I would argue that we need to be talking beyond this bailout, this emergency legislation, and toward a rebuilding of regulatory institutions, because it was the destruction of those regulatory institutions that led us to this point. People making decisions within a situation that was so fluid and so without boundaries and so without transparency and accountability that they were led quite rationally to do things that in the aggregate turned out to be disastrous. So I want to talk about bad government. Bad government, which was based on a flawed philosophy. And this is something, at least, that doesn't seem to be getting a lot of argument today. Even the head of the Securities and Exchange Commission, who was one of the people so enamored of deregulation and a neoliberal philosophy, has made a very rare public apology and said, gosh, well, I guess voluntary regulation doesn't work. My bad. My bad government. Most of the U.S. financial regulatory system that we no longer have was created in the New Deal and then on into the early 1950s. I think it actually worked pretty well. We didn't have crises like this. We haven't had a crisis like this. We've had some blips, but after the deregulatory system began to set in, but we haven't had a crisis like this since 1929 and the Great Depression, and I think that is evidence that the regulatory system worked pretty decently for everybody involved, and I've no doubt, having lived through the period of the 70s when people began to question the regulations on banks and so on, that it needed modernizing. What I don't think it needed was to be thrown out with the bathwater in the 1980s. Let me just tell you a little bit about how that systematic deregulation took place. There was, in the early 80s, in the Reagan administration, which of course brought into government a new political regime very much premised on the idea that government was bad. Ronald Reagan said that. Government's not the solution. Government's the problem. If we do away with government, we won't have these problems anymore. The free market will flourish and we'll all be better off. The first big industry to be deregulated actually was transportation. I don't think that's worked so badly. That was actually done under a Democratic administration. But as far as financial deregulation, it started with savings and loan institutions, and it was pretty much a disaster. In the early part of the Reagan administration, we deregulated the savings and loan thrift industry, and as a result, a lot of them did crazy things, made bad decisions, acting quite rationally, doing things they weren't prohibited from doing, acting within the law, but the end result was the taxpayers were saddled with a big bailout. $300 billion, that's in their dollars, more today, in FDIC payments, and we had to create a whole new bureaucracy called the Resolution Trust Corporation to dispose of all the bad assets. And so this was our first experience, and it didn't teach us a single thing about deregulation, sorry to say. And along come the 90s, when even before we had a Republican majority, the Republican majority then moving out from the White House, from the Senate, and into the House of Representatives, which happened with the elections of 1994. But even before that, so powerful was the deregulatory ideology, so hegemonic, one might say, that even when the Democrats had control of the White House and the House and Senate in 1994, they repealed the Bank Holding Company Act, really the last of the big parts of the regulatory net of the New Deal, and passed in 1956. And that deregulation was, I think, pretty important to the events that succeeded and gave us the current crisis. When you look at the cast of characters there, the people who are supporting it, one person who's always there is Alan Greenspan. And he was very strongly in favor of deregulation, repeal of the Bank Holding Company Act, and not instituting new regulatory processes for these exotic new financial instruments that Bob has talked about. He said that, in fact, this would be very, very good for the economy. He admitted that he had not done some things that had been permitted him under the repeal law because he said he thought the words were too vague. He was supposed to act, the Federal Reserve Board was supposed to act to counter unfair and deceptive practices, and he said those terms are so vague I just didn't pay any attention to them. He didn't, as the New York Times chided him earlier this year. He could have gone back to Congress and said, well, exactly what do you mean by how do you define those terms I'm supposed to do something about, but he didn't. In 1995, once you have this Republican Congress, in effect, then we got quite a surge of deregulation. They passed a law that restricted the ability of investors to sue companies, security firms, and accounting firms for misstatements. As the New York Times editorialized earlier this year, that helped to create the dot-com bubble and contributed to the Enron debacle, engendered a sense of impunity that led to excessive risk-taking and so on. The subprime mortgage market began to go up fairly sharply in the mid-90s, then leveled off for a while, and then you got another very sharp increase in the subprime mortgage market after 2002 with a further decline of regulatory oversight. In 1999, there was a big event in the deregulation process. It was the repeal of that grand old banking, commercial and investment banking regulatory law called the Glass-Steagall Act, named for a couple of Southern congressmen with some fairly strong populist instincts. This was one of the biggest regulatory laws of the New Deal, passed in 1933, and it was repealed in 1999, except for one part of it that has remained too popular to get rid of, and that's the FDIC. It's interesting, I think, that the bill that will be voted on probably tonight has an increase in the functions of the FDIC. We'll see if we can afford all the bailouts we'll have to do under that. But that has remained popular and is about the only part of the New Deal that has not been abolished. Congress, in order to make this bill more popular, sort of going back to these older financial regulatory modes, decided to double the amount of deposits that would be federally insured in order to increase confidence in the mortgage market. Well, the repeal of Goldwin-Smith, Glass-Steagall, GS. When I see GS, I think of Goldwin-Smith. It's a class location. The repeal of Glass-Steagall was important and interesting in a number of ways. For one thing, And I want to make clear that I'm not blaming all this on the Republicans, though. This was an ideology, deregulation, neoliberalism, that was brought in with Ronald Reagan. But President Clinton not only signed the repeal of Glass-Steagall, but encouraged it strongly against a lot of residual opposition in his own party and fear of a filibuster in the Senate. And so he was given a lot of credit in actually getting the bill passed, a Democratic president going along with this. Why was it so difficult for Democrats, a Democratic president, a Democratic Congress, to rise up and say, no, no, we like this old New Deal structure, we're afraid to abolish it, we don't want to have another depression, and so on. I think there are a number of reasons for that, and I would go back, though it sounds like a mushy term, to the hegemony of the neoliberal deregulatory philosophy. The Democratic regime, the New Deal regime, had been thoroughly repudiated and thrown out of office, and it simply did not seem legitimate to say, wait a minute, let's keep these parts of the New Deal that have served us so well. There are other things going on aside from that sort of lack of confidence in the Democratic Party that its old solutions might still work with some modernizing. One has to talk about, I think, the huge wealth that had been created in the 90s and the fact that that translates into very large financial contributions to Congress people. And as a matter of fact, Democrats were getting more money than Republicans, in part because they were committee chairs, or maybe in part because they had an interest. They tend to come from areas where the finance industry is strong. If you look at our current presidential campaign for Barack Obama, it's the fourth largest source of his funds, the finance industry, worth about $9 million to him so far, and counting. For McCain, it's $7 million. It's his third largest source of funds. He doesn't have as much to deal with as Barack Obama. For the Democratic chair of the Senate Banking Committee, he is the single largest recipient in American national politics of Fannie Mae and Freddie Mac donations since 1990. That may make Congress people, even Democratic Congress people, think twice before they impose any regulations on Wall Street that Wall Street very strongly opposes. And they certainly very strongly opposed any suggestion that new things were happening that ought to be regulated. The leader in the repeal of Glass-Steagall and several other bills in the 90s and early 2000s was a Republican senator from Texas, Phil Gramm, who was in the news recently because he was until a couple of months ago, the principal financial advisor to John McCain and presumably his next Secretary of the Treasury. Perhaps it's a good thing for all of us that he got in trouble complaining that, criticizing the American public for whining about Wall Street and financial problems, and so perhaps he isn't being seriously considered as Secretary of the Treasury anymore. But certainly it's pretty clear what his philosophy was. So with congressional leaders who very strongly supported deregulation, with the Federal Reserve Chair who very strongly opposed any new regulation or even using the powers his own agency had to impose regulation. You got what the New York Times referred to a little while ago as a shadow banking system that grew up, that was not regulated, not transparent, that involved exotic financial instruments that not many people outside Wall Street understood: derivatives, collateralized debt obligations, SVOs, credit default swaps, and so on. And always the federal chair, the chair of the Federal Reserve Board, when called over to Congress, like, well, what about all this new stuff? Or should we be worried? No, not to worry, he said. It actually helps to spread risk and stabilize the economy. Famous bad predictions. Barney Frank was quoted in a New York Times article recently for being, I think, implicitly criticized. Wait a minute, you were there on the House Banking Committee. Why weren't you doing anything about this? And it sounds a little naive, but let me read you the quote. So he talks about calling over the CEO of Citicorp, and saying that, he was a little bit worried, why aren't all these new financial instruments, why don't they even show up on your balance sheet? As Bob said, they weren't there. They were sequestered away. Why aren't they on your balance sheet? He asked the CEO. And Frank recalled that the congressman told him that doing so would have put Citigroup at a disadvantage with Wall Street investment banks that were more loosely regulated. The banks more tightly regulating the investment banks, so in order to compete, they had to keep these things a little bit quiet. And to keep up with their competitors who were allowed to take far greater risk. Not only, says Barney Frank, in retrospect, not only did Wall Street have this incredible freedom, but commercial banks had an incentive under the existing non-regulatory laws. They had an incentive to try and invade regulation. We thought they didn't need regulation, Frank says. And in the late 1990s and early 2000s, Wall Street was fighting bitterly against that regulation. In the fall of 2000 came another milestone, perhaps the coup de grace, in the steady march of deregulation. In a lame duck session of Congress, a law was passed that few of us paid any attention to, didn't know about. It was passed as an amendment to another law, I think without even a roll call. I've been unable to, in my short research time devoted to this, to find even a roll call on this bill. It was called the Commodity Futures Modernization Act, which effectively kept most of the market for derivatives, swap agreements, and other exotic instruments off limits to the agencies that regulated more conventional assets like stocks and bonds and futures contracts. And it was again sponsored by Phil Gramm, and it was again signed by President Clinton. In fact, President Clinton had his appointees on the Commodity Futures Trading Corporation worked with Gramm to draft this bill, and it was a very significant one. So the role of the president stands out here, the role of Congress. It cuts across both parties. I do think that right now the role of the president is quite interesting in the request for such a huge amount of discretion. I brought the bills with me, but you have these two bills, one of which was proposed to Congress by the Secretary of the Treasury. It's 3 pages long, and there was never a more remarkable request for complete discretion for the Treasury Secretary to act on his own with his advisors, whoever they might be, without review by the federal courts or by Congress, completely acting on his own discretion. That, considering that he is the president's appointee and the president signs off on it, has to go down in political history as one of the biggest attempts to expand the power of the presidency over the American economy that I can think of. As a result of this crisis that we're in now, depending on what happens, it may be that we are at that point when we will reverse our thinking and decide that, after all, the free market can only thrive. Trust can only be there to make the free market work when there is transparency, when there is confidence, when there is a government regulatory system. It doesn't have to imitate the New Deal. It may be quite different. But I am disappointed there's not more attention beyond this bailout, this emergency measure, to creating a new permanent regulatory structure, modern, able to deal with all these new financial instruments. But something will prevent what I think is a gigantic moral failing right now. Because people acted in their own self-interest, quite rationally, not illegally in most cases, the lack of a regulatory system enabled them to pursue their own economic interests, their own greed, if you will, and to hurt, as a result, so many people who had no direct role in this process. And that includes people around the world, and it includes you as students. I am very worried about the job market for my seniors who are graduating this year. It's not going to be there. It's not going to be very strong because of this governmental failure. So I would ask you, in in all your thinking about the economy to also think about the role of government in the economy, which has been at the crux of party conflict since 1896, and I think we need to rethink it right now. Thank you.
Thank you very much, Professor Saunders. I would just like to open it, before we open it up to questions from the audience, I'd like to give you each a brief few minutes just to comment on what was discussed, and maybe in the interest of debate and discussion, anything you might disagree on with the other panelists. But we'll keep it to about 2 minutes each, please.
Well, I'm not sure where to start. There's been so much covered, and this topic is so complex and so deep that you could really debate this for days. There are so many things that are confronting us right now in terms of what we should be thinking, what action we should be taking, and the regulatory element, I think, is a very important one. You hear a lot about the issue of greed and perhaps the importance of greed in the financial markets. And greed is a constant, and everybody acts in their own interests when they're given the opportunity to. So greed is a constant. It's always there. It's not something we can control. When an airplane crashes, nobody blames gravity, right? But gravity is always there. In the same way that when markets fail, greed maybe isn't the first thing we should look at, but I think as the professor pointed out, it's the controls in the market and what allowed it to happen. There are so many conflicts of interest when you get into the detail of how this thing started and how it rolled to where it is. There are so many conflicts of interest that are based on compensation and self-dealing and self-interest that it's hard to believe that nobody saw it coming. And in fact, there are a lot of people that saw it coming, so it's not really fair to say that nobody saw it coming. There are dozens or hundreds of portfolio managers that track data that tell them that this problem was out there and was going to come to a head, just like in the tech bubble of the late 90s. All of us in the industry knew that there was a downside to this whole thing, and we didn't know when it was going to happen, but we knew it was going to happen. So when we think now about the controls that are important to put in, I think that more time spent on that, more thought spent on that is critically important. I believe that there is an element of free market that has to exist, obviously. But there's also an element of control that has to exist. And where we run afoul is when we rush hastily to a solution on the regulatory side and put in legislation and regulation that is a knee-jerk reaction to the issue. Okay. We are competing as a country for the role of leadership in the financial industry. New York used to be the center. Now we talk about London. Now we talk about Dubai. Now we talk about China. There are a lot of competitors out there that in a void will step in and offer some of the alternatives that we might deem too risky. So I think we need to give some serious thought, and I would really welcome some very considered legislation on regulatory improvements.
Well, I actually think that two of us pretty much agree on this. Let me start by saying that there's more than enough blame to go around to everybody who was involved in this. I said it earlier, but the one part I left out was government. And government had a lot to do with this. There's plenty of blame there as well. And I think that we need to rethink financial regulation. I don't think there's any question about that. But I'm not sure that a lot of the deregulation we did to begin with was so bad. In fact, I think a lot of the deregulation we did was very good. We just have gotten used to some of the deregulation. You probably don't. The students here are too young to remember. We used to have the Interstate Commerce Commission regulating trucking and railroads in ways that when you looked at the details of what they did with trucking, for example, just did not make any sense. There were a number of regulations that had been created, and I think there was a lot of good that was done and taken away. We probably went too far with some things. I don't think there's any question about that. But now we're coming back and saying we need to re-regulate, and we actually already have done some re-regulation. So one thing that we did not long ago was the Sarbanes-Oxley regulation. It's a complex set of regulations. You know, it was trying to address a problem of transparency, and I'm really big on transparency, but it addressed it in ways that actually don't work very well. It's a very burdensome regulation, particularly for smaller firms. It's very expensive for them to comply with it. It's resulted in fewer firms wanting to list their stock in the U.S. because they look at this regulation and say, this is too costly, why list here? Why not list someplace else, like London or somewhere in Asia? We do have to be very careful about what regulations we put in because we're not living in a vacuum. I mean, the rest of the world is out there too. But we do need to think about how to do something that's probably more unified in regulation of the financial sector instead of having all these little pieces, perhaps having something that is a unified regulatory structure for the whole system.
Yeah, I doubt that we have a huge disagreement here, though I've really emphasized the political and regulatory side, and I certainly do think that a lot of the deregulation and modernization of regulation, certainly in the transportation sector and also in aspects of banking, were a good idea. It's just that it went too far. I'd just like to emphasize that for the founders of our political system, there was no assumption that people in this polity would be angels, would not be greedy, and so on. To the contrary, they had a pretty dim view of human nature. But they really believed that institutions, if you worked at them over time, because democracy is a work in progress, and it's surprising how much they got right in that document, I think, that they created in 1787, that if you work on it, you can create a set of institutions that creates good incentives so that, as Madison said, echoing Immanuel Kant, a race of devils would behave well in this regulatory system. So that's what we're after, not to make everybody good and noble, but to create a set of incentives and transparency and reporting and oversight, none of which, by the way, is in this document. And this is the expanded version, the 110-page version of the 3-page version that the Secretary of the Treasury gave us. What really disappoints me is that this is really all about a bailout, and it's not at all about creating a new regulatory system. And obviously, that will take time. It's too bad that we just, and even in the last few days since the failure to pass it surprised everybody the other day when the House failed to pass the bill, you've had a lot of economists coming forward with what sound like really good ideas to me. And look, you know, here's what we should be doing. This bill doesn't really do it. It's wrong-headed. It's going to fail. It's going to be a waste of money because we do it much better. It's too bad we don't have more time, if indeed we don't, to sit down and construct a rational regulatory system for the future, because I think that would help, too, to give us a lot of confidence. So maybe somehow we'll give ourselves a breathing spell to sit down and make up a good regulatory system to replace the New Deal.
Thank you. I would now like to open the panel to questions from the audience. In the interest of time, please keep your questions succinct and to the point, but we'll go ahead and open it up. So.
Wondering, since this is a global crisis now, it's still sort of originating from the US, why is it that it did not, for example, affect banks in Europe or maybe in Asia or something? I know it did, right? Everything dropped. But is the regulatory system so sufficiently different that it would prevent this in the sense that these stocks all just dropped because they were involved in the US market? Or is it just, no, that's the point. How is it different elsewhere?
So I'll tackle that to start with. So it's true, regulations are very different across the globe. At one point in the U.S., not far in the distant past, we decided to have really what I would call disjoint regulation of the financial sector. In England, they decided the opposite. They decided to do a unified financial regulation. Up until a couple of years ago, I think most people thought we had made the right decision and they'd made the wrong decision. So it's not actually clear which is better. But you know, this financial crisis is moving around the world. I mean, there have been bank runs and defaults in England, in continental Europe, in Ireland. They just decided to insure all bank and bank-like deposits because of runs. So it's happening everywhere, although it is true that the problem originated largely with the credit markets in the U.S.
Gentleman in the corner.
A lot of the problems that I'm hearing from you, I think, stem from the fact that corporations are extremely large. So, for instance, not only too big that we can't allow them to fail, but also too big because they have surplus intellectual resources they can use to outwit regulators, for instance. And also too big that they have too much money to offer to college, for instance. So how much of the problem has to do with over-large corporations, banks?
I said I heard a political element there.
So there's an economic element. So I'll say something briefly about the economic element, which is what's the political element. So, I mean, you know, I think it's right to be worried about the power, the political power of big corporations, but if you look at who originated a lot of these initial bad loans, it was not big firms. It was a lot of small firms. So I'm not sure that the size of the firms is so much the key on the economic side. It's more the interconnectedness of all of the firms that's creating the issue.
I'm an anti-truster at heart, so I'm always willing to speak up for a smaller unit society, a Brandeisian philosophy that believes that democracy works best when power is somewhat more decentralized. That's really a worry now, because one of the results of the current crisis is that you're going to end up with fewer and larger banks. And one of the problems that you point out, that we don't always connect when we talk about the virtues or vices of bigness, is precisely in a system like ours that doesn't really regulate anymore. I mean, it all fell apart this year. Campaign finance. You really do create the possibility with these very big pools of surplus funds to have an enormous impact on politics. And that, I think, is more advanced here than anywhere else. So I think you make some very good points about size.
Gentleman right there.
What do either of you think would be the next best alternative to the proposed bailout plan that would satisfy the concerns of the taxpayers?
Well, I'm pretty simplistic about it because I haven't been able to dive into and understand entirely the details of the plan. But I think what's critically important is the reestablishment of confidence in the counterparty and reestablishing some liquidity in the system. Where we have a crisis of confidence that stems from, as David mentioned, you know, looking into your borrower's eyes and not being sure whether you're going to be paid back. The capital lockup is in a good dose attributable to the fact that there are these loans and structures that nobody knows what they're really worth, and for capital regulatory reasons, you have to defend them by locking up some of your capital, and you want to keep your capital that's in excess of that safe from further deterioration. So I think we need something in the, to surface to take away that risk from the market. And the actual mechanism, I think, is something to be debated, but that's the immediate need, is to restore confidence in the counterparty and eliminate the source of the concern that will allow lending to go forward. That doesn't address the fundamental issue of the deterioration in the housing market, housing values, and the glut of housing. But you're not going to start addressing those issues until you give, in some measure, people who are credit worthy the ability to transact. And I think that's the key element.
Could I just respond quickly to that? I'm sure none of us has the solution to offer, but I would urge you to look at a few things that are bubbling up, and I'm sure you could mention other things that you find intriguing that are coming from economists, and you may very much disagree with this particular fellow. There's a Nouriel Roubini at NYU who feels that the problem should be addressed much more from the bottom up. Let's do something to help homeowners who really in the right situation, really could repay their mortgages and wouldn't have to be thrown out of their homes and lose their savings. And he talks about needing a new homeowners loan corporation like the New Deal, and goes into considerable detail about that as the key mechanism for recovery. There are some sort of smaller scale things that people talked about in the interim before today, but after the first failure in the House of Representatives, I was sort of impressed with Representative Scott of Virginia talking. He was the one who voted in the House against the bailout, sort of from the liberal democratic perspective. He said he didn't like the idea of the Treasury going in and just soaking up everybody's, like, give me all your poor, your huddled, your really awful loans, and we'll take them off your hands. And that's the kind of Wall Street bailout that I think so many Americans really are opposed to, even if the failure of the bill is quite self-defeating. They just don't like that idea. And he says if there could be some better way that you would put in a law of evaluating the quality of those things. And surely it's not beyond human imagination of economists and Wall Street people to come up with ways to evaluate this stuff so that the Secretary of the Treasury doesn't end up just absorbing all the really awful stuff, and which is a great boon to the Wall Street firms. Scott was really hoping they'd put something in about that. Other people were hoping that there would be more emphasis on the government taking an equity stake rather than just a bailout, taking all the bad loans up and taking care of them, but an equity stake that would give you more voice within the corporation. There's a provision for that in the expanded version that the Congress imposed on the Treasury Secretary, but it's so vague that it probably won't really do much. I was very hopeful that the people who are crafting this bipartisan compromise with the Treasury Secretary would see the need to do some of those things to make this, if this is what's going to pass and this is the best we can do, to put some of those better measures into the bill. Unfortunately, what they decided to do, and this is probably so typical of our politics, to get this bill passed was to throw in a couple of sweeteners like low-interest loans for windmills and solar panels. I mean, just nothing whatever to do with the financial crisis, and raising the FDIC guarantees, but that's not what they ought to be looking at.
Yeah, and the devil's in the details with this program. The bailout references valuation work, and there have been a number of people that do this for a living, the Bill Grosses of PIMCO and the like, that are willing to do the valuation work on these mortgages to establish value. But the detail of exactly how the valuations are going to be established and how they're going to be brought into this fund are very vague. If the government can buy these mortgages for 50 cents on the dollar and they're actually worth 65 in the end analysis, we as taxpayers will make money. But we don't know how they're going to go about valuing and what the mechanism is that will bring them into the fund.
The gentleman in the front here.
First, I'm going to make a comment, and then I'll ask the question. Okay? No one here seems to look at the root cause of the trouble in the economic system, which will now go on, maybe for another 5 years, and cause the collapse of the U.S. economy, just as in Germany in the 1930s. And it will probably lead to another Hitler.
Please be brief, sir.
The problem was created in 1913. It was created at Jekyll Island, a great moral failure if there ever was one. It was and is unconstitutional. It's the Federal Reserve. Jack Kennedy tried to fight the Federal Reserve and was probably killed for it. I'll end shortly, thank you. It created the crash of the 1920s. It created the real estate and the stock market bubble of the 20s, and then it put the clamps on with tight money and caused the Great Depression. It caused the 1940 dollar to be worth a nickel, if that now.
And your question, sir?
The question is, should we not get rid of it?
The lady with the...
My question, since in quotes the bailout term is so vague and so poor, shouldn't Congress, and I hate to say the President, be using the bully pulpit to talk about getting rid of arms, fairness, really bringing everything back into line, not just throwing money out in a black hole.
Well, I mean, so I think that the way to look at this bailout is that it's a first step, and it really is, if it makes sense, and I think to some extent it does, it's an emergency measure that may give us a chance to actually then sit down and think carefully about how to regulate the whole system. But it is absolutely right to be worried about how this is going to work. I mean, as Bob mentioned, we might actually, as a country, make money on this deal if the valuations are done correctly. But I see nothing in the existing bill to convince me that that's going to happen. So, we should be concerned and we should push to be sure that it is done right, but I don't know if it will happen.
Confidence, though. Confidence for the country to want to get moving again, and it's not just throwing out $700 billion.
If it makes you sleep, makes all of us sleep a little bit better. I certainly think that when the bill went from 3 pages to 110 pages, it got better because there are some provisions for oversight. Paulson, as brilliant as he may be, and as public spirited and so on, I think he will benefit from the expansion of his advisory network to include a few other people in government. And also, he will have to report to Congress, and I think they're going to be on his case and asking, why did you do that? Why did you pay 50 cents for something that was worth zero and waste these taxpayer funds? So it certainly is better than the original plan, which just said, trust me, I'm going to go in and clean things up.
All the way at the back? Yeah.
Both major presidential candidates have said that they're trying to make this bill really lightweight so that it can kind of speed through the Congress and get passed. And I'm wondering, from the business and the economic side, what is the urgency behind getting this bill passed? And perhaps the political side of, when it's passed, do you think it's largely a political problem, or these extra apparatuses that they should add to it? Or do you think they just don't want to do it at all?
I'll start. You can fill in. I think that the urgency stems from the funding, the need to fund these, these vehicles so that they don't collapse. All right. The commercial paper market, as we mentioned before, is a short-term financing market that has historically served the purpose of financing the working capital of companies. Okay, so if you need to buy inventory to manufacture a product so that you sell, you use the commercial paper market often to finance the purchase of the materials that will go into the production of inventory, and you use it until you get proceeds from the sale and repay the commercial paper, and everything works smoothly and you can access it quickly and you pay it off in 30, 90, 120, whatever it is days. And that's kind of the way it's normally gone. When the concerns about the commercial paper market first surfaced, it didn't have a big impact on the traditional corporate issuers in that marketplace. It was questions about the asset-backed commercial paper market that seemed to be most relevant at that moment. With the bankruptcy of Lehman, there has been a change in the way the rest of the commercial paper market has been treated. And the cost of issuance in the commercial paper market and the ability to issue in the commercial paper market has been impeded by that. And that is a significant difference versus what it was a year ago when the Bear Stearns asset vehicles became troubled. It's not just the commercial paper market. It's the repo market. It's all short-term financing markets, and it's the liquidity function of the financial markets that's impeded, that I think that people feel the urgency to alleviate the pressure on so that money can flow again and credit can be issued again to worthy borrowers.
So I think that's great. Let me just add one little thing, is that if you let this continue, the real effects build on themselves. So, if firms find it hard to borrow money to expand or to even operate, if state and local governments can't borrow money to undertake their projects, then they start not hiring people when they're on the job market, as some of you, I suspect, will be. They start firing people. Once you start down that road, it gets very hard to turn things around quickly. So there really is an urgency to get something done to give us a chance to then step back and think about what we need to do for the long term. But I think we need to do both.
I would say that I hope that long-term thinking starts immediately after the election, since it obviously hasn't, as you point out. Neither candidate has really said anything or offered any kind of plan, except that neither of them wants to be blamed if it fails, so of course they both endorsed it. But whoever's elected, I hope they'll do what Roosevelt did, except do it better. Get a brains trust together and start working on a program so that you're ready to go in January when you're inaugurated, to establish a new regulatory system for financial markets that will be more sane and more unified and more effective than it has been. And I think it would be nice to know, and is not beyond what we should be asking these people, who are your economic advisors going to be? Who are your brains trust, to use Roosevelt's name? Who are they going to be? Which economists are you going to be counting on to help you do this? It might help us decide which one we want to elect.
I would like to take one more question at this time. The lady in the very back.
My question, why don't we bail out the mortgages directly, pay them off? If the structure that's teetering is based on those mortgages, why not? Ironically, Paulson said in February this year, people pretend they want to help out the homeowner, but really when they want to bail out Wall Street. And that's now he's skipped that step and he's bailing out Wall Street. So why isn't the household sector important? It seems to me that's why the anger comes from, and the disreputableness or the lack of buy-in in the political sense to the bailout idea is that so much of the country is left out of income gains, wealth gains, and now we're not paying their mortgages either.
Plus, why not just pass a law that says people can pay rent until they're able to get out of or refinance their mortgage? It's so simple.
Well, I suspect we can all say something about that. You have to be really careful about rewriting contracts that people got into in the first place. But in the new version of the bill, there is an aspect of what you have in mind. Maybe not as much as you like, but the idea here is that when the government buys these mortgages, the government then is going to have the ability to renegotiate the mortgages. It's hard to renegotiate a mortgage you don't own. I mean, I suppose you could tell the firms that made the mortgages, look, too bad, we're just going to renegotiate it. That's not the kind of thing we normally do. It would cause all kinds of concerns about what happens next. But if you buy it, then you can renegotiate it, and that is being proposed.
I think it's unfortunate that it's not better developed in this law. The procedures that will be used to help people keep their homes and refinance and so on. Originally, the Democrats had asked for something to be put in to go, and you'd be able to go into court and get your mortgage negotiated downward. That didn't make it into the final bill. But one thing that appeals to me from the NYU economist is the idea that we have a lot of expertise in our housing agencies, precisely in helping people with mortgages and negotiating mortgages. It's unfortunate that this bill does not contemplate using that expertise, but instead, apparently, I say apparently because I'm not quite sure from reading it, that the secretary will be able to sort of contract this out to other firms, and they will help the homeowners. And we're just not sure if that's really going to work well for the homeowner.
Okay. Well, on behalf of the entire Cornell International Affairs Review Board, I would like to just say thank you once again to our wonderful panelists, Professor Easley, Professor Endolina, and Professor Saunders.